we saw inflation break multi-year highs in 2021, and then finally, in the end of 2021, we saw the Federal Reserve Bank and the government come out and admit that inflation is not transitory and that they were wrong when they said that inflation was transitory. And now here we are in 2022, still seeing high inflation. They say that this inflation will cool down in the second half of 2022, but they also said that in 2021. So we don't know how long this inflation is going to stay. So if you're wondering what you should be doing right now with your money, you're in the right place. What's up, everybody? I am Jaspreet Singh from the MinorityMindset.com, where money minds rethink rich. Inflation has been a hot topic for more than a year now. And the concern that the average person has is, I have some cash in my bank and my cash is being eaten away because of inflation, and I'm earning a salary and my salary isn't stretching as far. My rent is getting more expensive, my groceries more expensive, my life is getting more expensive. So what do I do now to want to just protect my money against inflation and to ideally profit off of this inflation? What can I do to benefit off of what's going on, because the rich and the wealthy keep getting wealthier because of this inflation? Now, I can't tell you what you should be doing with your money. I'm not a financial advisor, but what I can do is talk about what I am doing with my money. That way I can take advantage off of what's going on with inflation right now. And that's what I want to do in this video. I want to talk about what I'm doing with my money, how I'm investing my money, how I'm allocating my money. That way you can get a better understanding of things that you could potentially do because of inflation. I know we're talking about how to capitalize on inflation when it comes, but you really don't want to wait until you see more inflation to do things. The way that you really capitalize off of inflation is by being prepared for it, and by making the right decisions with their money today. That way, as more inflation happens, you are the one that's benefiting because of inflation. Because there are ways that you can invest your money to protect your money against inflation, and then there are other ways that you can invest your money that way you can benefit when inflation happens. So you got to be doing both. You need to be using your money in a way to protect you, to protect your wealth, and then also benefit from this inflation. Because if you see too much inflation, well, then that could cause crashes in the economy. It can cause a crash in the dollar, or it could cause a crash in the stock market, or it can cause a crash in the real estate market, or it can cause a crash in the cryptocurrency market. And so you have to be able to play whatever happens, which means you need to be making smart decisions with your money today. You got to start by understanding what inflation really is, because a lot of people have a flawed definition of inflation. They assume that inflation just means that the price of things are going up, but that's not what inflation is. I mean, it can be a side effect or a symptom of inflation, but the prices going up is not actual inflation. Inflation comes from the word inflate, right? Increase. What are you inflating when you have inflation? You're inflating the monetary supply. You're inflating the currency. That in turn devalues the currency, because as you create more dollars, as you create more money, each dollar now has less buying power. Each dollar gets diluted, so it dilutes the value of the currency, which in turn can cause the price of things to go up. I say it can cause the price of things to go up because you can also see the price of things go down when you have inflation, because let's assume that you have improvements in technology, or you have improvements in supply chain, or you have other improvements to make the cost of producing something go down. When the cost of producing something go down, well, then the price of this item will go down. And you can have inflation and see the price of something go down. But if you didn't have this inflation, if you didn't have the dilution of the dollar, the price of this item would have fallen even more. So yeah, you can see the price of things go up or down in inflation, but without inflation, the price of things wouldn't go up as much and the price of things would fall faster. There are 5 ways that I invest my money. Some of these things are aimed at trying to benefit from inflation when I see inflation, and some of these things are more of a hedge to protect me against super high inflation. I'm going to be going over these 5 things, starting with number 1. But before we do, I need you to do me a quick favor and smash that thumbs up button below. And if you are looking for some extra guac, meaning some extra Minority Mindset, you can check out some of our other newer Minority Mindset channels. First is the Minority Mindset Clips channel. You asked for shorter Minority Mindset videos again, and that's what we did. In the Minority Mindset Clips channel, I am publishing my shorter videos. These are usually 8 to 12 minutes long, every single day, 7 days a week. So if you miss my shorter videos and you want to see those in addition to these videos, you can check out the Minority Mindset Clips channel, because I got videos going on over there every single day. Then we have the Minority Mindset News channel, where we have Nate publishing videos every day, again, on what's going on the top finance and business news. So if you want to stay up to date on what's going on in the world, check out the Minority Mindset News channel. And then we have the Minority Mindset Spanish channel, where we publish my financial education content in Spanish. So if you want to check out and subscribe to these new Minority Mindset channels, I'll put the link to where you can do that in the description below. The first place where I invest my money is in physical real estate. Now for me, I use this less as an inflationary hedge and more of as a way to generate cash flow, but it also benefits when inflation happens, because the way that real estate investing works is you can go out and buy a property. Let's assume that you're buying a home. You buy this home for $100,000 and you can rent it out to a family for $1,000 a month. Well, if we start to see more inflation, what happens? Well, we've seen home prices go up because of inflation. So now your home might be worth $110,000. But more important than that, you also see rental prices go up. And so now instead of charging $1,000 a month, you might be charging $1,100 a month to make up for your higher costs and the higher cost of living. And so now you benefit from the more inflation because now your rental prices go up too. Now this is the point where you usually hear people say something along the lines of, oh, greedy landlords, all they're trying to do is rip off your tenants by charging them more money. You are the reason for inflation. But that's not exactly how it works. See, if you own a property, you have expenses to pay with that property. You have to pay for property taxes. You have to pay for repairs and maintenance. You have to pay for your insurance. And so when more inflation happens, guess what? Your insurance bill is going to come in higher. So you have to pay higher insurance fees. Your property tax is going to go up because now the assessor is going to say, oh, your property is more valuable. It's 10% more valuable. Let's try to raise your property taxes by another 10%. And now when you have to do a repair, the contractor is going to say, well, it's going to cost me more money to get the tools and I have to pay my workers more. So I have to charge you more money in order to do the repairs, in order to do the maintenance for your property. So costs go up for maintenance and managing a rental property, which is the big reason why rental prices go up. But that's not the only reason why rental prices go up, because you might be saying, no, some landlords raise the price of their rent because they want to make more money. And that can happen, but in order for that to happen, there has to be an increase in demand to justify this higher rent price, because that is different than inflationary raising rent prices. Inflationary rent prices happen because, okay, the cost of everything go up, so I have to charge higher prices in order to make up for my higher costs. That's one thing. The second side is, okay, I'm investing my money into a growing area. This area has more businesses coming in. It has more people that want to live here. And because more people want to live here, it is a more desirable area. And now property values have gone up because it's more desirable. And because more people want to live here and there's not enough supply of homes here, now rent prices have gone up because there's more demand than supply. We list the home for rent, and the first weekend that we list it, we have 40 applications of people wanting to live here. At this point, people don't really get as upset when you see rent prices go up, because that's with the market. The market goes up because the area becomes more valuable and more people want to live here. That's different than this inflationary increase, which becomes inevitable because you have the higher cost of managing your properties. But in either case, this is where it benefits for you to be the one that's financially educated and to be the real estate investor, because now if you own the property, you can continue to generate the cash flow. And if you start to see the more inflation, well, now you can also raise your rents to balance off your higher costs. That way you can still generate cash flow. And if you had to sell that property and property values go up, well, now you can also benefit, because if that inflation caused appreciation in the price of your home, well, now your asset is worth more money. Now, I'm going to give you a little bit of a disclaimer here, and I'm pretty sure I'm going to have to give you a similar disclaimer with every single asset class that I talk about. But the thing that you have to understand with real estate is that real estate prices do not always go up. Remember 2008? Real estate prices don't always go up. That wasn't the only time that we saw a real estate crash. Real estate booms and busts happen all the time. 2008 was just an anomaly because that was a whole real estate collapse. What you have to understand is that real estate prices do not always go up. So when you're investing in real estate, you want to make sure that the investment makes sense in terms of cash flow. Meaning, okay, I'm going to buy this property today and it's going to generate me positive cash flow, meaning it's going to make me a profit today. So I don't got to dig into my pockets every single month and pay for my mortgage and pay to keep this property. People are doing this right now. And you saw this also happen before the 2008 crash, where people were so excited to own a property in a certain area that they would overpay for the property. And then every month, even with a tenant in there, they would be losing money because the property taxes, the mortgage, the maintenance fees, and the insurance and the other costs were so high that they outweighed how much money they could make in rent. So they were paying money every single month. And you're going to say, why would anybody do that? Because their hope was that the property would appreciate in value and then eventually eventually they'd be able to sell the property for a huge profit. You are seeing people do something similar today, so you just got to be careful that when you're investing in real estate, that it is an investment property that's actually making you money, meaning it's positive in cash flow. When I invest in real estate, I don't invest for appreciation. I don't care what's going on with property prices. If property prices go up, great. If they go down, oh well, I'll just go out and buy more. So this is where you have to understand, what is your goal with investing in real estate? For me, it's the cash flow, which is why I'm not too worried about the appreciation. I'm looking at what type of profits I can generate, and I always want to have that cushion there, because if the economy slows down and now you have to lower your rents, you don't want to be, again, digging into your pockets to make sure that you can make ends meet. You want to make sure that if the economy slows down and you have to lower your rents, that you have that cushion there. That way now you're still okay. Maybe you don't make as big of a profit, or maybe you don't even make any profit if it really slows down, but at least you're not digging into your pockets to keep the property. So the reason why I like real estate is because it's an asset that I can see, feel, and touch, and the rental income can be balanced through inflation. And if we started to see some sort of crazy inflation, super high inflation, hyperinflation, if those things come into fruition and the dollar became worthless, well, you can always change the currency of what you charge your rent. I mean, if you needed to, you can change your rent instead of dollars to chickens. Say, pay me in chickens instead of dollars, or you can change it to Bitcoin or gold or really anything that has value. You can work a deal with your tenants because you own a physical asset that's providing value that people are using. The second place where I invest my money is in the stock market. Now this one's interesting because the stock market is a place where you can go and invest in your favorite companies, and it's a way for you to get exposure to the economy in general. Now the stock market and the economy work similarly, but they don't always work linearly. So if the economy is going up, that doesn't always mean that the stock market is going up. And if the economy is going down, that doesn't always mean the stock market is going down. You might remember that when the 2020 crash happened, the economy was going down like this, but the stock market was going up like this. This was through the help of the Federal Reserve Bank when they opened up the money printer and they started pouring money into the markets. So the Fed started creating inflation, and then inflation was seen in the stock market. So who did that benefit? It benefited the asset owners, people who invest their money in the stock market. Let me put this in perspective because it'll help you understand why this is so important. So you saw an economy that was collapsing. And during that time, the stock market was also going down. And that's when the Federal Reserve Bank committed to doing whatever it took to make investors feel confident in investing their money in the stock market. So the Federal Reserve Bank said that they would print an unlimited amount of money and put this money into the market. So the stock market started crashing, the economy started crashing because the economy was shut down, and then the Fed said, okay, we'll print as much money as we need to boost the stock market back up. So now they started printing this money and pouring it into the stock market. And what did this do? It caused the stock market to rally, so the people that were buying stocks or the people that owned stocks started to benefit. But now what happened? Well, for one, if you didn't own stocks, you were effectively poorer because, one, this new inflation caused the devaluation of your currency. The value of your dollar went down, which made it now more expensive for you to go out and spend money. It made it more expensive for you to go out and buy your groceries. It made it more expensive for you to go out and get your health care. It made it more expensive for you to go out and buy a home. It made everything more expensive because the value of your dollar went down. But at the same time, it also became harder for you to go out and buy stocks because your dollars became less valuable while stocks became more valuable. You see, because the value of your dollar kept going down while the price of stocks kept going up. So it created a bigger divide between the rich and the poor. Again, this is why financial education is so important. That divide was created by the Federal Reserve Bank because they chose to bail out the stock market. So now what do? Well, you can get angry and say, oh, that's not fair. This is such a messed up system. And yeah, you're right. It's messed up. Anytime the Federal Reserve Bank creates more money by printing more money or by lowering interest rates, it creates more inflation, which hurts the average person. It hurts the person who's not financially educated. It hurts the person who doesn't understand what inflation is, but it benefits the rich, the wealthy, and the people who are financially educated who understand what inflation is. So what do you do at this point? Well, if you ask me, you need to learn the rules of the game because this is the way that the game works. Hate it or love it, this is the way that the game works. So what should you do? Learn the rules of the game. That way you can be a winner in the game. That means use your money to buy the assets that benefit when this type of inflation happens. The Federal Reserve Bank showed that they were willing to print money, create inflation, hurt the average person to help people who were investing their money in the stock market. Now, the good news, thanks to technology, is you don't need $1 million or $100,000 or even $1,000 to start benefiting from this type of inflation. I mean, thanks to so many apps out there, you can start investing your money into the market with literally as little as $5. So there's no reason for anybody not to be doing this, but it's a way for you to get exposure to the markets, for you to get exposure to the economy, for you to get exposure into companies. Now, obviously, you need to be doing your research, because what's going to happen, especially if you're a first-time investor, is you start throwing your money into the market, you get excited, you see some money in the green, and you're like, oh yeah, I'm making a lot of money. And then you see your portfolio go down, and now all of a sudden, you don't know what's going on. You thought you were a financial genius because you were making money. Now all of a sudden your portfolio's down and you don't know what to do. Do you panic? Do you sell? Do you let go of everything? And this is where a lot of people lose money, because they don't know what to do. Or they start making their money and now they're like, I'm a financial genius. And then they start making more risky bets. They start looking for more risky options. That way they can double their money overnight, essentially. And this is where you have to now take a step back and get educated and understand that the people that make the most money over the long term are the people that are investing their money into something that they believe in, that is a financially sound investment over the long term. That means, yeah, you might see the market go down, and yeah, you might see your investment go down. But if it is a sound investment, all you should be doing when the market is down is buying more and then letting time and your money compound. That way you can see your asset grow, you can see your company grow, you can see your investment grow, which means over time it will allow you to make more money. This is where the next layer of concern is, but what if I put my money in the market and the market crashes? Well, that is always a concern. But again, what did I just say? If you see these type of crashes or dips, that's where you want to come in and buy even more. It's like Black Friday for investors. It's an opportunity for you to come in and buy assets at a discounted price. So this is where you need to be doing your research. Know what investments you want to own, know which assets you believe in, which have good fundamentals. And when you see these pullbacks, that's when you want to come in and buy more aggressively. And to keep up with my end of the promise that I said just a minute ago, yes, investing has risks. You are never guaranteed to make money when you invest. You might even lose money, so make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. But the way that you can mitigate your risk is by educating yourself, because if you start learning how to invest your money in the market, you start learning the different strategies, you learn the difference between trading and investing, and then you start learning how to analyze a company, you learn how to read a cash flow statement, you learn how to read a profit and loss statement, you learn how to analyze an earnings call, you learn how to understand a company's moat, you learn how to understand a company's executive structure. Now you can make much better decisions with your money instead of just looking at whatever your friends are buying and buying that too. Because now you're actually analyzing companies, you're valuing a company, and you're saying, oh, this is a good company. It's a little overvalued right now, but I'm going to wait for the price to pull back a little bit. When I see the price come down, that's when I'll come in and buy. If it falls even more, you can buy more aggressively, and then you sit and wait and let the company do its thing. And if you keep up with the earnings, you keep up with the company, and it continues to perform, it continues to look good, well then that's how you know you're holding on to a good company. If inflation is really the concern, that means the buying power of your dollar goes down. And if you're investing into companies which have the ability to raise the price of the products to help match inflation and cover their inflationary costs, well then you'd be benefiting and you'd be okay, because now you're invested into a company, or you're invested into companies which now have the ability to fight inflation by raising the price of their products in order to pay off some of their higher expenses. And I know I get a little off topic when I say this, but this is a very good education point, because this is where everybody says, oh, these greedy companies, they just keep raising the price of their products, and that's why we're seeing inflation. But that doesn't really look at the full picture either, because companies see the costs and the effects of inflation as well. Because now when they have to go produce their t-shirts, or when they have to go produce their chips or their products, their food, whatever it is that they're producing, they have to pay a higher cost to produce their products. They might have to pay higher wages to their employees. They might have to pay higher money to produce and source their raw materials. And because of that, they have to charge a higher price, because they're facing higher cost pressures. They're facing the higher costs. And so in order for them to stay profitable or to continue to stay in business, they have to raise the price. Otherwise, they wouldn't be able to sell the products. So you have two different inflation numbers that you have to look at. You have the consumer inflation number. A lot of people like to look at this as a CPI. There's a lot of different indicators that look at it. But you have the consumer inflation, and then you also have the inflation that producers face. This is the inflation that businesses face. And what we saw happen in 2021 is that companies and businesses, producers, the PPI, the inflation that these companies faced was higher than the inflation that consumers faced. So what does that mean? Companies actually saw higher costs of their goods, but they didn't raise the price of their products enough to match the higher cost of their goods, because one of the big reasons was everyone was told that the inflation was transitory, and so they were hoping that this inflation would just go away, but then it didn't, and so now they're facing this dilemma where they have this higher cost of producing their goods, and they're hoping that, hey, I hope the cost of my production will go down. That way I don't have to raise the price of my product so much, because they understand that if you raise the price of your goods, it doesn't look good for consumers. But now it's facing a weird dilemma where companies are seeing their costs go up, and they're going up higher than what they can charge, and so they might have to raise the price of their products more to match their higher inflation that they've been seeing. This is why you really have to understand the definition of inflation. That way you can look at the root cause of inflation, because when people say that inflation is just a rising of prices, well, then you can say, well, the reason prices are rising is because companies are charging more money. But you have to look a little bit deeper. The reason why you see more inflation is because the Fed increased her monetary supply. When they increased the monetary supply, it decreased the value of the dollar. When it decreased the value of the dollar, it cost companies more dollars in order to buy the raw materials. When it costs them more dollars to buy the cost of the materials, that means it costs them more money to produce a product. If it costs them more money to produce a product, that means they have to sell it for a higher price, which means ultimately you are going to need more dollars to go out and buy stuff. So it goes back to the ultimate root cause, which is increasing the monetary supply. We're going to jump back into the video in just a second, but before we do, I want to tell you very briefly about Market Insiders, our investing coaching program. If you've been thinking about investing your money into the stock market, the real estate market, or the cryptocurrency market, and you're looking for some extra guidance, this is what Market Insiders was created for. It is not a class. Market Insiders is a coaching program where every week you get access to a real estate class, a stock market class, and a cryptocurrency class, which is live, led by one of our investing coaches. Our investing coaches are not investing gurus. These are real investors who have been investing for years, they've gotten great returns, and they have the money behind them. I'm talking about hundreds of thousands, if not millions of dollars invested themselves, and they're teaching from their experiences and their failures. That way you can learn from them every single week. Now, the cool thing about Market Insiders is you get access to more than just the weekly coaching. You get the weekly investing coaching, you get access to all of our previous recordings, you get access to our investing classes, and you also get access to our private Discord community. That way you can chat with other investors. So if you're trying to get started as an investor in the stock market, the real estate market, or the cryptocurrency market, or you're trying to figure out how you can be a better investor and get better returns, then Market Insiders is for you. That way you can get that kind of handheld coaching guidance, because now it's not just a class where you're going to be left hopeless trying to figure it out for yourself. Every week you're going to get access to stock market, real estate, and cryptocurrency coaching sessions, and it's all included. Now, if you're skeptical about all this, I get it. That's why you don't have to pay a penny today. You can try out Market Insiders for free with our 10-day trial. During the 10-day trial, you'll get access to everything. You can join the coaching calls, you can watch the previous recordings, you can attend the classes, you can go through the Discord and chat in there, you can ask your questions, and then you can see if it's right for you. If during those 10 days you realize, I hate this sucks, well, then you can quit and it's not gonna cost you a penny. But if you go through it and you say, wow, this is amazing, I'm blown away by the education, well, then you can stay. And if you decide to stay, it's not gonna cost you an arm and a leg. Market Insiders cost less than the cost of going out to eat. It costs less than $30 a month. So if you wanna try it out, I'll put the link to how you can learn more and join Market Insiders with a free trial in the description below. It was very important to me that you feel comfortable investing in your financial education. That's why I wanted to make sure that you had nothing to lose and everything to gain, which is why if you wanna learn more, you can get started with a free trial. That way you don't have to commit to spending a penny until you know if it's right for you or not. So if you want to learn more and try out Market Insiders and see if it's right for you, I'll put the link to where you can get started with your free trial in the description below. The third place where I invest my money, again, this is not really an inflationary hedge, more for a place for growth, is in businesses. And these are businesses that are not on the stock market. So obviously, Minority Mindset is my business. This is a business that I run, it's the business that I own, but I also invest in other startup companies. These are companies that I invest in because I like the idea of investing in innovation. I like the idea of investing for growth, and I love working with entrepreneurs. I'm an entrepreneur. I love supporting other entrepreneurs, so that's a way for me to invest in other entrepreneurs. Now, on a more theoretical level of why, you have to understand that our economy is very large, and we also have some economic issues where we have a whole bunch of national debt. And so just practically speaking, our economy is not going to be able to grow as fast in the next decade as we saw our economy grow in previous decades. Like, our economy is trying to grow at around 2% a year now. So if you're investing in value companies, you're trying to invest in some of these more stable, safer companies, chances are you might not see the same growth and appreciation that your parents or grandparents saw when they were doing the same thing. And so you have to be willing to take on a little bit more risk if you want to see some of the higher returns, because you need more innovation to see more growth. And that also comes with some more risk. But if you want to see more growth, you have to be willing to take on more risk, especially now, just because our economy is so big. And it doesn't look like our economy is going to be growing as fast in the coming decades as it did in previous decades, just because when you're a big, large machine, it's a lot harder to grow bigger and faster, versus when you're a smaller machine or a smaller company, think of it as a smaller company, you can grow a lot bigger faster because you're smaller and you have more market share that you can take. Now, this is definitely a riskier way to invest your money because, well, most startups fail. And so if you're investing your money into startups, you have to expect that some of your money is going to be wiped out. We're going to invest in companies that you think are great, and then they're just going to go bust. They don't go anywhere. So you have to understand that, and you have to be willing to stomach that risk. I like it because I understand entrepreneurs. I can add value. I can potentially advise some of the companies that I invest in, and I like the innovation that I'm investing in. Like, one company that I'm invested in is a company called UpCounsel. This is a company that is trying to revolutionize the way that you get legal work. Now, I'm a licensed attorney. I don't work as an attorney, but I am an attorney. And as an entrepreneur, I can see the inefficiencies in a legal workforce. Like, if you go and hire a corporate law firm to do work for you, they're going to charge you a lot of money. Some of them are going to charge you more than $800 an hour. Some of them are going to charge you more than $1,000 an hour. But the attorney that you hired isn't going to get all $800 or $1,000 an hour. They're going to get a tiny, teeny little piece of that, because most of the money is going to fund the entire corporation. You got to pay the equity partners, and then the higher ups, and a whole bunch of people, and then the person that's actually doing all the work gets a small share of the amount of money that they're making. So now it's bad for you because you have to pay a whole bunch of money and you don't know how good the attorney is. And it's not good for the attorney because, well, they're not making that much money and they got to do all the work. So this is where UpCounsel is trying to change that. They're bringing tech into legal as a more affordable way for you to get access to this type of legal work, because now you can work directly with the lawyer. So you pay less money and the attorney makes more money because now you're going directly with each other. That's why I like investing in startups, because I get excited about this type of innovation. It's cool to me. I really enjoy this. If you don't enjoy that, then definitely do not be investing in startups, because one, not only are you going to be annoyed by it, but there's a lot of risk associated with it too. And so that's not a good combination if that's not what you like doing. Now, again, this used to be very hard to do. If you wanted to go out and invest in these type of smaller, non-publicly traded companies, you had to be an accredited investor. It was very hard to get access to these companies. But now, thanks to something called Regulation CF, it's a new regulation which lets you invest in these more smaller startup companies through equity crowdfunding. Crowdfunding is where these companies can raise money on a public platform, and in exchange, you get equity in these companies at an early stage. Again, highly risky, but it provides you with the opportunity to invest in startups with as little as like $100 or $250. It just depends on which company and which platform that you're using, but you can start investing in these companies with just a few $100. And there's a few companies out there that'll let you do that. Some of them are Republic, one of them is WeFunder, one of them is Start Engine. I'm sure there's more, just look them up. There's a bunch of companies out there, but these are crowdfunding platforms which let you now go out and invest in some of these startups. And it's a platform where you can see startups that are looking for investment opportunities. And again, just understand the risks before you invest your money. The fourth place where I invest my money is in cryptocurrency like Bitcoin. Now, this one is for a little bit of upside, plus protection against inflation. Our dollars are an inflationary asset, meaning there's no limit to how many dollars you can produce, and as you produce more dollars, the value of each individual dollar goes down. Now you can compare that to something like Bitcoin, which is a deflationary asset, because with Bitcoin, you have 21 million Bitcoins and you cannot mine anymore. So if people try to buy more Bitcoins and you have more and more people trying to buy these Bitcoins, well, then that pushes the price of Bitcoin up because you have a limited supply and a growing demand. But in order for that to work, you have to also have the growing demand. That is the key part that makes Bitcoin functioning, because you need that demand of people that want to actually buy and own Bitcoin. Compare that to the dollar. The reason why the dollar continues to have value is because the government is behind it. The government says that the dollar has value, and they say that you have to use the dollar to make transactions, and because of that, the dollar has value. Bitcoin, on the other hand, is because people believe in the value behind Bitcoin and they're starting to lose faith in the Federal Reserve Bank. And they don't want to trust the government with their money. So that's why people are moving to the money to things like cryptocurrency and Bitcoin, because it is an inflationary hedge in that sense. But in order for it to really be a hedge, you still need that demand and that belief behind Bitcoin. So the risks with investing in Bitcoin are very different than the risks of the other asset classes that I talked about, because when you invest in real estate, you have a physical property that you can see, feel, and touch. When you invest in stocks, you're investing in a company that's already producing some sort of value that's being used. Like if you invest in Amazon, you're investing in a company that's selling products. Like, you know what Amazon does. And when you're investing in a startup, well, you can see that the startup is trying to produce something. They're trying to produce some value. They might not, which is why some startups will go bust, but that's what they're trying to do. With Bitcoin, you can't really see it the same way. I mean, you can't really see the value of Bitcoin here in the real world, but you know in the digital world that it's a way for you to store your money. It's a way for you to store your property. It's a way for you to store your assets and a way for you to protect your money. So you have to go through the learning curve to kind of understand, where does Bitcoin really play a part in my life and how will it play a part in the world? I mean, if you believe that cryptocurrency is going to be the future, then it's one way for you to now protect your money against inflation because you believe in Bitcoin and you want to own it. And as more people adopt it and as more people get open to the idea of using Bitcoin and cryptocurrency, you're going to see more money flow into cryptocurrency and Bitcoin. But again, the risk here is it's highly speculative, which means you're going to see massive booms and busts. You can see major rallies, major crashes very fast. And if you're not willing to understand that and take that risk, then maybe you should step back and not look at cryptocurrency yet. But if you understand it and you believe it and you want to own it for the long term, then that's something you can consider buying. When I was talking to Michael Saylor, who is the CEO of MicroStrategies, he and his company have bought billions, with a B, billions of dollars worth of Bitcoin. And what he says is, if you're not willing to hold on to Bitcoin for at least 10 years, you should not own it for 10 minutes. And the fifth place where I invest my money is into physical commodities like gold. I own physical gold. Now, every Bitcoin person watching this is saying, why in the world would you own gold? And every gold person watching this is saying, why in the world would you own Bitcoin? Look, Bitcoin and gold are different, but I look at gold as real money. It takes time, effort, and labor to mine an ounce of gold, so you can see where it is a store of value because it took actual time, effort, and labor to mine gold. It does take effort and time and energy to mine Bitcoin, but it's different. Bitcoin is different because there's also technology behind cryptocurrency and Bitcoin. Gold is a way for you to store that money because it is a commodity in that sense that it can be used in the world, it can be used in jewelry, it can be used in other things, but it takes time, effort, and labor to mine gold, and that representation of that time, effort, and labor is stored through the physical gold. So I look at gold like physical money. Now I understand gold hasn't really done much in the last decade, but that's not why I buy gold. I don't buy gold to see appreciation. For me, this is just a real hedge against inflation. If you saw real inflation, the value of the dollar goes down, well, then you would need more dollars in order to buy that gold, which means then gold relative to the value of the dollar would go up. So if we talk about just a straight hedge against inflation, that is what gold does. It is just a pure hedge. And so for me, I think about it like this. It is real money. I look at gold like real money. I don't care what happens to the price of gold, whether it goes up or down, doesn't matter. I just own physical gold as real money and it sits there. And if I wanted to just bury my money in my backyard, would I rather bury cash or would I rather bury gold? I would rather bury the gold because I know it is a better store of value than paper dollars, because your paper dollars are supposed to be some sort of store of value. Right? If you go to work every single day for a year and you earn $50,000, you earn $50,000 of paper money. That is the store of value that you got. But if you take the $50,000 and you just bury it into the ground, well, in 10 years, that $50,000 isn't going to stretch as far. Does that mean that the $50,000 with the work that you did isn't as valuable? No, not necessarily. What it means is that the store of value that you used, the dollars, to store that value that you created, lost its buying power. That's why I rather would store the gold than the paper. Now again, this doesn't mean that you shouldn't have any cash savings. There is a time and a place for cash. I mean, if you see markets go down, that is where cash can be very handy because then you can use cash to go out and buy. But you just have to understand where each asset class has its place. There's a time and place for gold. There's a time and place for Bitcoin. There's a time and place for startups. There's a time and place for stocks. There's a time and place for real estate. There's a time and place for cash. And you have to understand your risk tolerance, your goals, and then align your money habits and your financial decisions based off of what's important to you right now. Everything that I talked about in this video are just the things that I'm doing because it aligns with my goals and my strategies. But you have to, again, be financially educated. That way you can make smart decisions for your money.
I mean, either the Fed is completely incompetent in its belief that inflation is transitory, or it knows it's permanent, but doesn't want to admit that. Because the problem the Fed has is that if it admits that inflation is here to stay, well, then it has to do something about it. But